Good morning, Arya community. This is Mark Owen from Trade and Train. Please forgive me wearing a cap. Lockdown has unfortunately given me a very bad hair day and I am still in need of a barber's. So obviously Arya have asked me to produce some content for you, and I'm going to talk about the COT report today. This is something that isn't widely used in the industry, but it has some very good information that can help you decide where a market is potentially about to run out of steam or gather momentum. So I'm going to run through this with you right now. So what is the COT report? Well, it's the only true volume measurement within Forex. And when I talk about volume, the best way to think about it is if you want to buy a share in a company, then you have to go to a stock exchange to purchase that share certificate, and that is your recorded volume. Now with FX, there's so many places or institutions where you can buy currency from, so there's no real true recording of it apart from in the futures market. So what happened was the US set up an entity called the CFTC, which basically covers every transaction that is held within the futures market. Now you are either regarded as a commercial entity, a non-commercial, or a speculator, i.e. a non-reportable. And I'm just going to go through those. Now what we have here is, see, anyone can get this information. It's free from the CFTC website, but this is how it's produced, and for you to then try and regurgitate this information and make it into information that you can utilize and then be able to see it visually to be able to make a trading decision based on the information gathered is pretty difficult. You know, it costs hundreds of thousands of pounds to put a platform in place to be able to put the information into a digestible manner for you then to be able to go away and make informed decisions. So this is looking at the Swiss franc. Now remember, because it's a futures market, there's no pair involved. It is purely looking at the Swiss franc. So as you see contracts increase or decrease, and that means potential strength or weakness, that is regarding to the Swiss franc as a whole. So if you're looking for Swiss strength, that would be Swiss strength across all markets, or Euro strength across all markets. So just remember that, because it is a futures market, there is no pair. It is purely that one market we're looking at. So you can see here you've got different asset classes. Over here we've got the non-reportables. Effectively these are traders that are large enough to be recorded, but at the same point have no sort of best way of describing it, they're generally always wrong. Then we talk about the non-commercials. So these would be what we look at in terms of speculators, trend followers, and then on the other side we've got the user and the producer. So the user and the producer, they are predominantly always short. So let's take a look at this information. So here you can see the number of long contracts, here you can see the number of short contracts, and then the spreading, and again through all these different markets you can see how that's calculated. Now how do we look at these markets and the categories? So the commercial, like I called them earlier, they are a user or a producer, and they only use the market to facilitate business transactions. Okay, so the best way of looking at a commercial would be somebody like, let's talk about Nestle. Nestle will buy sugar the cheaper it gets. Why? Because they can stockpile it, but yet they can't change the retail sale price of their cereals or their bars or anything. So the more cereal they buy at a cheaper price, the more they lock in terms of profit, in terms of their end use. So that's the same with commercials using currency. So BMW, for example, let's say they've got a lot of euros in the account, and yet they have purchasing to do from the UK, and all of a sudden UK or sterling drops massively. What will they do? They'll buy more and more pounds to stockpile to cover rents, mortgages, wages, purchasing. Now the purchasing prices will probably stay the same, the rents or the mortgages will stay the same, but because they've managed to buy pounds at a lower rate, they've actually locked in more profit or P&L in their balance sheet for the end of year. So what we're looking at in terms of a commercial is they are particularly or predominantly short the market. They are hedgers. So they don't do it for speculative purpose. They do it to hedge and protect and lock in profits through business transactions. Non-commercials will be on the other side of that. They are your hedge funds, your institutions, investment banks, investment firms. So they're always looking for investment opportunities. So they will buy the trend or they will sell the trend. Commercials are the inverse to that. They will sell into rallies and they will buy dips. Okay, so they will buy more and more the cheaper something gets, and they will sell more and more the more expensive something gets. Whereas non-commercials, the trend followers, they will follow the trend. They will buy more and more as the trend increases and sell more and more as the trend decreases. Non-reportables, well, these guys, they're pretty much, they try to be speculators, but they're usually on the wrong side of the can all the time. So we don't follow the non-reportables. The purpose of this video is purely, we're going to focus predominantly on the commercials, okay, because this is an introductory into the Commitment of Traders report. So the COT Index, what is a COT Index? Well, the best way of describing the index, it is a way of measuring the values of the long and short contracts minus to create a net position. And then what we can do is we can compare that levels of buying and selling activity to previous months and years gone past. And it's the only way that we can do it accurately by creating an index. So the index allows us to view trading activity of a group of traders on a relative basis so we can determine their level of bullish or bearishness. Now, an index is created on a scale of 0 to 100. The market or the index can never go above 100 and it can never go below 0. We are looking for opportunities when we see the index go to 90 and 100, between 90 and 100. That will give us an opportunity looking to say, well, based on this and previous buying and selling experiences, we know that as soon as we go above 90, this is time to be aware that the market could start moving to the upside. If we see the market go below 10% and towards 0%, this is a time to start looking at where we could see some bearishness activity come into the market. So this is how we start looking for our active signals. Now, how does the COT cycle work? Well, in simple terms, what we're trying to establish is, I'm just going to bring in my laser pointer here. So in a normal trend, obviously we're seeing the market producing higher highs and higher lows, and as trend followers we want to buy the dips and get out somewhere as close to the high as possible, unless you're a swing trader and you're going to be moving your stops as price creates new highs and you're going to be coming under the lows. So how does the COT market work? Well, very, very simple. As price moves up, your commercials, so that's your user and producer, will start to reduce their long contracts and start to increase their selling activity. And that would be the flip for non-commercials, because a trend is potentially starting. So you will start to see non-commercials increasing their long contracts as non-commercials start to increase their short contracts. And then what happens is, through natural flow and the supply and demand theory through economics, as price gets to a threshold where the commercials have literally flushed the market with so much supply that the non-commercials can no longer take up the demand. They can't physically acquire everything that is in the market. There's only one thing left for the market to do in order for these short contracts to be acquired, and that means that the market has to reduce in price. Okay, so based on that, as we see the market reach a pinnacle, and we know that the commercials are extreme levels of selling activity in an uptrend, and the non-commercials are an extreme activity of buying, we know that we are very, very close to a top in the market. And this is shown time and time again in history, and how we can look to basically profit from these maneuvers. Now, how does this benefit you if you're a trend trader? Well, trend traders, the trend, follow the trend until the bend in the end. We always know that trends can go on longer than we anticipate. However, wouldn't it be nice to know that you're not looking at a indicator? Because I know most people will look at indicators for divergence or Bollinger Bands for overextension. Yes, look, that does work. But wouldn't it be nice to know what the actual inside of the market is doing? And that is the key to knowing where and if a top is likely to be formed. Is it 100% successful? Absolutely not. Nothing will be 100% successful, But what this does is it shows you what the commercials are doing, and the commercials are generally right. Okay, they own the market. They are the biggest users of the market. Speculators are not the biggest users of a market. People that facilitate business transactions on a daily basis throughout the course of the year own probably about 60 to 65% of all transactions made. So these are the people that you really, really want to be following. Now, the bit in the middle, all this, the trend, you keep trading that and trade it and follow the non-commercials, But where we start to get to extreme levels, and then we can tie that in with its seasonality, or we can tie it in with just your technical analysis, then these are going to be key elements to be looking for excellent selling opportunities. So let's have a look at what the data looks like. So in the top section here, this is a weekly chart, and the reason it's a weekly chart is because the COT data is collected every Tuesday and released every Friday, 8:30 p.m. Eastern time, UK time, sorry, so 3:30 Eastern time. So we're looking at how price is moving in the top. This section down here, you're probably going to look at it as an indicator. It is not an indicator. This is an index based on these three lines here. So the green line highlights how many long contracts we have in place each week. So if you were to put your cursor over the green line, it would tell you the number of long contracts in the market as of Tuesday last week. Go back one place, it will tell you the number of long contracts in the marketplace the previous Tuesday. The red line, that shows the selling activity, and the blue line is just the long contracts minus the short contracts, gives you the net position, the blue line. So the blue line is obviously, here you can see short contracts are going up, long contracts are staying flat, therefore the net position is declining. Now if we look at what happens as price rallies, you can see as price rallies, the index falls. Why does the index fall? Well, the index falls because commercials, as price is increasing, will be selling into this rally. Why do they sell into the rally? Because they can get more bang for their buck. If they've produced the commodity or the currency, so to speak, or they're using it, and the more it increases or appreciates in value, they're going to sell it because that is them gaining from the market. Okay, and we can see it time and time again. Now in terms of looking at the index, there's three different indexes that we can look at. One is a 36 month, one is an 18 month, and one is a 6 month. And you're probably going to ask how we decide which one to look at. Well, I'll reveal that in the next slide. The three lines we have down here are exactly the same as these three lines, except these are for the non-commercials, the speculators, the trend followers, the investment funds, hedge funds, investment banks. This is what these guys are doing. When the market, you'll see here, this is 0 and this is 100k. Right, 100k is just referring to the number of contracts in the market. It's nothing more than that. Certain markets, if you're looking at crude oil, this will be in the millions. Now, when we see the 0 line and the blue line above it, that highlights that the speculators are long the market. Now, an interesting fact and something to be aware of is when we see the red line go below the green line, or above the green line in this instance, and the net position changes from here, net long all the time, to net short. This can be a clue that the market is potentially about to reverse. So that could be an insight that this market is about to roll over, and we could be starting to look for a potential new trend to the downside, or at least a correction. So that's three different charts we've got, with obviously the market on top. So how do we decide which market cycles to use? Well, the best way to look at it is, here's the 36 month, here's the 18 month, and here's the 6 month. The objective is to match these peaks and troughs with the market that you are focusing on. So based on the look back period, the cycles of a 3 year and an 18 month and a 6 month are going to vary, but it's you basically want them to mirror what's happening on the chart above. So if, for example, let's say the 36 month is never hitting 100% and never hitting 0%, the look back period is too big. If the 6 month is permanently on 100% and permanently on 0%, the look back period is too small. You want your cycles to be mirroring as much as possible the chart you are looking at. So now if we bring across a chart and look at this chart here, and then I've overlaid all 3 look back periods. So we're just trying to find the natural cycle. So as we look at this market, ideally you've got a high here, you've got a low here and a high here. So which of these lines is best fitting the peaks and troughs of the market? So you're looking at this, and I'd probably go the blue line, which is in this instance the 6 month. You can see that the blue line here, the 6 month look back, picks out this high. There's obviously, we can see here, it's telling us to sell at this point. Here it's telling us to buy. You get a little rally, but then it drops back down again, gives us another buying opportunity. The market rallies. We get a high here. You can see the blue line back down here telling us to sell. Here we're at 100% again, telling us to buy. Now again, it's telling us to buy. So what we can see is the blue line, the 6 month look back, was pretty much in line with all those market tops and bottoms. Okay, you might have had a losing trade here if you'd taken something, but this is all about forming that bias and that opinion. What are the big boys? What are the owners of these markets doing? So this is this was gold, by the way, and looking at gold, wouldn't you want to know what the owners of the mines are doing in terms of, are they selling, are they buying, or are they reducing their positions? Because that will give you a really good insight of where price is likely to go. So let's take a look at a couple of examples right now. So we've got the sugar market here, and I'm trying to give you a variety of markets because, as we said, these look back periods, 6, 18 and 3 years, they're not going to produce setups every week and every month. But what they will do is they will provide excellent opportunities for those of you that are looking at the mid-term to longer term trades. If you're just looking at getting a quick book and trading all the time, this methodology, it will help you in terms of the initial trade, and then you can look to trade the trend if you don't want to hold the position. But let's take a look. Sugar, look what happens here. Price rallies, index declines, comes to 0, gives us a selling opportunity. I've marked in the 90 and the 10 with the red lines here. Now, as price goes stagnant through here, you can see there's not a lot happening with the index. Okay, we got above 90 here. We hadn't seen a significant sell-off, but price then, we see a nice big sell-off here. We've gone from 1250 pretty much down to just above 10, so we've had a 20% decline in the market. We've seen the commercial index pushing higher, touching 100, and then as we get that move from just about $11 up over $15, touching 16. So we've had a big sort of 45% increase in value. Look what the commercial activity has done. They've been selling all the way through this rally. They've been selling. We come down to 0. Now, I know that 15 is a significant number on sugar, and then boom, look at that. We've gone straight from 15 all the way back down below 10, a massive 60% depreciation in the price of sugar that you could have taken, and literally that was a waterfall. No real effort in that. Yes, you might have held the position a few weeks, but what a fabulous trade. And that type of trade, if you can pick 3 or 4 of those up throughout the course of the year, you may get more, but if you can pick 3 or 4 of those up, this is a serious account building style of trading. And then obviously if you are an intraday trader and you want to trade sugar on a day trading basis, then that's down to you. I probably wouldn't advise it on something like sugar. It can be a little bit whipsawy, but it's definitely okay for the 4 hourly or daily charts, or weekly if you want to go that bit higher. We can see that from here the market came down. Look what happened. All of a sudden the commercial activity started, the index started to rise. Now there's a reason it probably started to rise, because through this period, what do we notice? The market's selling off. So as the market's selling off, you're going to find that all of a sudden commercial activity will start reducing those short contracts and start looking to be buying them again. And as the market moves, we can see we've started pushing back up, pushing higher. So now they're selling into this rally, and this market right now, this was a sell last week and it's moved in our favor slightly. This was a trade that we sent out to our members club last week. We are short sugar. We are also short soybeans, which I'm going to show you in another slide in a moment. So let's take a look at the British pound. Again, remember, let's highlight the fact that the British pound, this is a futures market, therefore it is not in a pair. We are looking at this solely as a currency on its standalone basis. So if we see opportunities for weakness or strength, we would then look at that against all other markets. Prime examples, just highlighting a couple here. The index is at 100. We can see the market comes into structure here. We have a nice little move up, sells off. This is about April, if I remember rightly, through the seasonal weakness of the US dollar. So a great time to be looking to get long on British pound. The market then rallied. We had a little pullback into structure, giving us more confirmation with price and the dollar index, the COT index, giving us another extreme, and then that market just went ballistic. Here's our sell signals. You know, you'd have looked to have got short about 1.7, got stopped, and then take the trade again. Market moves fabulously in your favor. You know, these are trades that very rare to happen, but to move from 1.7 to basically 1.5 in a straight line, and it doesn't matter what your trade management technique is, you would have captured most of that based on the type of trade you're taking here. Because it is a commitment of traders trade, you would be holding that position for a significant period of time, and you would be giving your stop loss room to breathe. You wouldn't be managing it, micromanaging it on hourly charts. You know, you want the trade to move, you want to allow your position to encompass any sort of swings that are involved. So we can see now where these markets find opportunities. If we just come back again, look, we can see through here the COT index giving us extreme long opportunities. The market rallies from about 1.3s up to 1.6. Here we're looking at sell opportunities. I didn't mark them all on, but look, if we can see here the COT index back to 0, we form a high that starts the next move down. Here we can see we're about 98%, gives you that relief rally, and then all the way over here we get a 0%, and this was around Christmas, New Year's Day, if I remember rightly. A nice big waterfall from about 1.63 all the way down to 1.5. You know, I'm talking about these, and these are 1,000 pip moves. This was roughly a 2,000 pip move. You don't need many of those to make your trading year a fantastic trading year. Okay, so let's have a look at a couple of recent examples. So for our traders community at Trade and Train, we send out a watch list every week based on what we're seeing and potential trading opportunities. Now you can see that the asset classes that are being focused on at the moment, you know, we've got wheat, corn, soybean, sugar, soybean meal, New Zealand dollar, copper, Japanese yen. Prices that we were interested in to see the market test, and you can see I highlighted sugar at $15 that we're looking to see what happens with price. And then where the numbers are red, this just means it's bearish for that particular market. Why? Obviously just no inclination. It doesn't add any value or any further sentiment to that particular trade we're looking at. So we're going to take a look at soybeans. So soybeans, we highlighted a price of $1,250 to watch for a selling opportunity. On the 36-month, 18-month and 6-month look back, the index was at 1%. We can see that the commercial longs had slightly increased by 1%. The shorts were flat, the speculator longs were flat, and the speculator shorts had increased significantly. So this was something that was interesting, but let's take a look at the chart now and see if we could line up any technicals. So if we can look back here, we can see that price had pushed right up into that 1250. So this was a key area before price then fell down into just above the 1,000, just above the 900 barrier. Now if we also take a look at this point, what were the commercials positioning? So if we come down, we can see the red line, the short contracts, just above 500,000. We can see the net position just about here. Now let's take a look across. So at the same price, we can see here that the commercial activity had increased and was a lot higher than previously over here. So the commercials were selling into this rally very aggressively. We can also see that the new low on net position. So we've got the blue line that I've highlighted has created a new low, which means not only are we seeing activity from the short contracts increasing, we're seeing the long contracts decrease and creating a new difference. Speculators are doing exactly the opposite. We've got a massive rise in long contracts. We can see that the net position has been moving. Now, we highlighted up previously that the short contracts had increased by 17%. Now, if we look at the red line, 17% from down here just shows that there's not much selling activity going on. There's a 17% increase down here is very minimal, but if we'd had a 17% increase up here where the long contracts are over 120,000, you know, a 17% increase up here, that's going to see about a 20,000 increase. Where if we look down here, the short contracts, 100. Actually, sorry guys, that's mistaken. So this is where my key was over the wrong board, because if we look here, the short contracts are going to be just over 0 and the long contracts are going to be around 200,000. You can see where my keyboard is highlighted, where these dots are, so forgive me, I was just trying to look at the numbers in here. And so if we see here right now, the short contracts are going to be around, I would say, about 10 or 20,000. Long contracts are going to be about 230. So a massive difference here. This shows us that we're very close to being forming a top in the market. And how do we then look to trade it? Well, it's simple. This is where we add our technical analysis and we send out our signal where we look to short the market here. You can see that the type of reward we're looking at is significant, and the reward basically is measured based on previous movements. So yes, we're looking at an extended target down here of about $940, but where we have our alert, this is where we'll be looking to bank our first profits. Just above that 1,000, we've got our alert set here. The market's moved, we've pulled down, potentially formed a lower high now, and second trades are in. So we've had our first trades, we're now looking for a new low and then an additional trade. So that's soybeans. Hopefully that one can work out. If that one works out, it's a nice way to finish or start the next year once we can potentially close that out. And then the final trade we're currently looking at is looking at some weakness in the Japanese yen. Seasonally, it's a very poor period for the Japanese yen, but we need to see a little bit of commitment. Now, I've just highlighted, you can see the natural swings where prices created a high, the COT Index created a 0%, and then we saw the aftermath. The market went from 9,500 basically to about 8,700, 8,800, and then just through the early part of this year, the commercials gave us that warning sign to be a buyer of Japanese yen. The market shot up. As it shot up, the commercials then became aggressive sellers and gave us a warning sign to sell that market. So if we'd have followed the commercials, what they did in that short period of time, we've gone from in a space of 4 weeks, we've gone from aggressive buyers to aggressive sellers and basically taken a lot of profit out of the market. Now, what we're waiting for here is essentially this rising or ascending trend line to break. We can see that the commercials are aggressively short. This red line highlighting the short contracts, if we look all the way back, you can't see the short contracts or the short activity from the commercials, anything like that pre-January 2018. So we are at extreme levels for 3 years right now. So looking for some commitment from the commercials for selling activity, and that'll come when we see the market break through this trend line. If we were to then revert to, let's say, the US dollar Japanese yen chart, that would be looking for a break above sort of 105, because I wouldn't really want to get too committed in trading US dollar Japanese yen, and the reason for that is the US dollar is very weak and we're not seeing any sort of signs of reversals from the US dollar in the commitment of traders report. So I would be more inclined to be looking at other markets where that are strong, and that could be something like New Zealand or Aussie dollar, as they potentially have strong finishes to the year. So if you've got any questions about the Commitment of Traders report or would like some more information, please don't hesitate to reach out at mark@tradeandtrain.com. I hope you enjoyed the information, and I look forward to putting some more content out for you in the near future. Bye bye, have a great day.